The first quarter of the financial year is done and dusted. Stock markets have lost 10%, marking the worst quarterly performance since 2008. A heavy-duty week of news flow was capped with the government imposing new taxes on Friday. And it's also perhaps the perfect week to kickstart our brand new offering, the Editors Roundtable on CNBC-TV18. We bring to you the latest happenings of the week gone by, the big trends to watch, sharp insights and in-depth analysis from the CNBC-TV18 editors. News, views, numbers, trends, we have it all for you in the next half hour, and we are coming to you live from India's largest newsroom. This is the CNBC TV18 Editors Roundtable, starting now. Welcome to the show, guys. Well, it's been a really hectic week, right? And we shouldn't be sitting in the office. We should be sitting elsewhere, right, Nigel?
Well, that's right, Sonia. But what a week for the markets, right? I mean, I think, we have this uncanny ability of every time we're focusing on the globe, what's the Fed going to do? The government brings us back home. There's plenty to discuss, what's going on even on the domestic front. So, what a taxing week, but glad that we're headed into the weekend.
Tax was the magic word, right, that he said.
And windfall tax, right, at that. And how do you define? I mean, that's going to be the topic which we will all talk about. But I just want to say something. I mean, there are 5 of us here. It's a new show. It's a new format. And I think between the 5 of us collectively, we have, I was calculating, what, 80, 100 years of...
Almost 100 years, or more than 100 years.
You're making us sound very old, Prashant.
Cumulatively, so market experience and being on TV as well, right?
Correct. Absolutely.
And we were all feeling, there was this nervous energy as we were starting the show. So, I mean, we were as fresh as kind of newbies, but very excited with this new format. I mean, you said that we should be out of office. We're almost out of office, right? Or not quite?
Hopefully, in the next half an hour. But we're here every week. We're going to be here from the biggest newsroom in the country, right? To give you all the biggest market action. In case you missed it, we'll wrap all of it up in the next half an hour. Anuj?
Yes, indeed. And you know what? It's a Friday, but the excitement level on a Friday evening, I've never felt so high. And I'm telling you, because it's the start of a new show, and we've really worked very hard on this, Sonia. And of course, what we're trying to bring here, as Prashant said, is all of us spot something, right? And all of us have our own strengths. So we thought that maybe it's best all of us can combine our strengths and perhaps bring that on board. Of course, good to have Nimesh also on.
Well, though it's a Friday, and normally it should be a lighter day, right? And Nigel normally talks about cigarettes, wine, beers, and today actually ITC was up 4% thanks to whatever. Just wanted to push the Nifty up. But again, I guess today Friday such a tough day, largely because all of a sudden from nowhere, as you rightly pointed out in the morning as well, it came out of the syllabus. Some windfall tax, and we saw what happened. I must have called some 40, 50 people today, and absolutely nobody knows, what really went wrong and what really is going to happen next, right? So that's something we'll have to discuss.
But I think also, it comes at a time, Anuj, and I want to get you in on this. It comes at a time when, in any case, the Nifty and the market has been vulnerable, right? So it just needed that little bit of a push, and there it fell off a cliff. You think that's what hit the market?
Yeah, and you know what? Nimesh actually makes those 40 calls almost on a daily basis. But Sonia, I'll take it from there then, and let's talk about the market this week. And I tell you what, for me, this was the most resilient market that we had. The market, almost everything was thrown at the market, and still the market managed to defend some crucial levels. A major policy move on the oil front, and still that didn't break the markets back. We had a very big comeback in the second half. Why is that important? Is because we had Victor Schwartz who said the biggest risk to the market from here on is going to be policy mistakes. Now I'm not saying this is a mistake, but this was a policy decision which failed to break the markets back. So I think in that sense it's very important, because the big question is, if Reliance underperforms from here on, then what happens to the market? Because Reliance has been a strong point for the market. So I think that's something to keep an eye on. The other thing that stood out for me this week was that while the downside was capped for the market, the upside was also getting capped, somewhere around the 20-day moving average. So I think that's something to keep an eye on. One thing which would give comfort to the bulls is that there's some kind of selling exhaustion by FIIs. You know, we're no longer getting $1 billion a day. We're down to 2,000, 1,000, some days even 800 crores a day. So I think that's good news for the bulls. And we're talking to a lot of CEOs and CIOs from the mutual funds who believe that the domestic money is continuing, and I think that is going to keep the market in good stead. Just one last point about what we can watch out for next week. Very important cues lined up. New series, of course, it started today, but it will catch up next week, and the earnings season will start next week. But really, for me, the big one to watch out for is the promoter action, because whenever you start to see a spate of buybacks, you're somewhere close to the bottom. We've started to see some of that. So I think I am more positive than negative on the market given this week's trading action.
Okay, more positive than negative. The bulls would like to hear that. You know, this whole windfall tax, right? And I want Nigel to take it forward. But what really stayed with me is R.S. Sharma's comment where he said a fixed amount of windfall tax is not a fair way of assessment. So, Nigel, you want to take that forward?
Well, that's right. Let's get our audience up to speed with regard to what went on. And there are a couple of things that were announced. One was on the taxation on the export front, and the other one was really with regard to the cess as well that was announced. Well, let's take up the taxation front first. The government has levied tax on windfall gains that are made by domestic refiners on exports. Which are the stocks that are impacted? Well, for ONGC, there's no impact whatsoever. So that's point number one, because they don't export. But for Reliance Industries, the street was a little bit nervous whether or not they would fall into this tax net, because you know, their units are in SEZ units or EOUs. Well, the finance minister came up with the clarification, which is flashing for you on the screen. In fact, let's hear out the clarification coming in from the finance minister as well as Vivek Johri, and then we'll continue.
We are happy that exports are happening. We are happy that companies are making profits. We are happy that exports are giving them that kind of returns on the investment, which is so required for anybody who does the exports. But these are extraordinary times. These are times when the oil prices internationally are unbridled. They are just going on and on upwards. And for any country like India, for instance, which depends largely and very much largely on imports, we also need to pay that kind of money to get the imports. But when from India exports are happening and at a price which is abnormal, extraordinary profits, we don't grudge people earning profits.
The levy is clearly meant to apply to refining units in SEZs. That is a policy intent, and so it is applicable. Suitable changes have been made in law because in the SEZ Act there are certain statutes that are mentioned under which duties are not applicable to exports made from SEZs. But the statutes under which these duties have been levied do not find mention there. That is the reason that is the legal modality through which duty has been imposed on SEZ units.
Well, JP Morgan, they acknowledged that yes, this tax implication on exports, that's what's going to hit Reliance Industries. But they said that it will cap the profitability on the refining business from here on. And they put out a couple of numbers. They're saying the GRM for the next couple of years will be $18.5 and around $12.5 per barrel. But even taking into account this export tax, well, they're expecting it to outbeat it. So JP Morgan continues to remain positive on the stock. They also went on to add that, you know, on the energy vertical, on the consumption vertical as well, Reliance Industries, well, they'll continue to do well. So they remain positive on the stock. The second factor was the cess that was levied of close to around 23,000 rupees per ton. Well, that equates to, on a per barrel basis, close to around $40 per barrel. So the hit out there would be on ONGC upstream companies, Oil India as well as Vedanta. For Vedanta, it could hit their total consolidated EBITDA by roughly around 5% odd. Remember, for ONGC, well, you have quite a few triggers out there. It was a valuation cheap stock, it had a dividend yield, and also the street was factoring in close to around $50 per barrel odd. But unfortunately, this windfall taxes come in there, and that's what's going to hit them. The other cautious notes are, obviously the stock had the street was a little bit cautious on was the gas pricing. Will it be hiked to the level they were expecting? Can production ramp up? And also, you always get this divestment that comes in there. So those are the factors that are cushioning the stock. But nonetheless, this came out of nowhere. So that's why the stock was under pressure. In fact, earlier today, we spoke to Mr. Surana as well as Mr. Sharma, the ex-HBCL head, as well as the ex-ONGC head. Let's hear out what they had to tell us.
I would say it is a very, very heavy burden this has been cast on ONGC. So I don't know what would have gone in the mind of the policymakers to impose such a huge windfall tax, and why it is not ad valorem. In windfall tax, instead of ad valorem, it is done a fixed amount. I don't think that is a fair way of imposing a windfall tax. I'm absolutely at a loss on the mechanism that is done, fixed amount being levied. This is like the excise, the cess used to be levied in the past.
There is a windfall gains to oil producers because of exorbitantly high crude prices. And I think that will generate some resources for the government, which they can utilize for other purposes or for giving comfort on the downstream side.
Okay, you heard all the experts talking about the windfall tax and the implications, but this is the news which actually spooked the investors today. And I mean, just to sum up the entire mood in the dealing rooms for this week, I guess this was a big talking point today. And the feedback was, while this was unexpected, but this will spook the investors to some extent, especially in the PSUs and all the companies where there will be windfall tax. So all those sectors will be minutely monitored, I believe, this weekend. So that's something to watch out. As Anuj pointed out, there, the intensity of FI selling has lowered, and yes, that's a feedback as well from the dealing rooms. But do remember, even the volumes have been on the lower side. So this month of June, the volumes are down 30% in the cash market. So that shows there is a lack of participation as well. I guess from individual stocks point of view, there were some clean out trades as well. So that's what quite exciting. The likes of Heikel and all, and periodically you're seeing whether the promoters or PEs are looking to exit via block deals. So that's something which was part of the chatter list as well. And of course, the next two things to watch out in terms of individual stocks or the events would be, one, there is a Shriram Transport and Shriram City Union shareholders meet next week for the proposed merger. So those stocks were in action this week. And of course, also watch out for the Ambuja Cement, because people have started talking about arbitrage trades in Ambuja Cement because of the expected open offer. So those are a few things to watch out. But I guess from a feedback point of view, I guess the lower sell-off, that was a key highlight, which even Anuj pointed out, that the intensity of FI selling has actually lowered to a larger extent.
I think one factor is the FIs, they were giving in the harder blows. Now the DIs, they're coming in there and it's blow for blow. And all through the week, that's something that we, if you look at it, in fact, for this week, normally the difference between the FI selling and the DI buying was close to around 500 or 1,000 crores odd. All through the week, it didn't cross more than 100 crores on the positive side as well as on the negative side.
Nigel, just to add to your point, while you're talking about FIs and DIs, this week the feedback was some bit of participation from retail and HNIs have started picking up, and especially in the broader market. So we'll have to watch out for that as well, because some bit of anticipation of good numbers could be started pricing in the mid cap in the broader market.
Just before I toss to Prashant, the FI exposure is at the lowest ever in terms of longs. So there's nobody to sell now. I mean, we reach such a level, the real test of the market will be if there's a rally, and in that rally, if the FIs come and sell or not. That I think is going to be the real test. And of course, a lot will depend on how the global winds are blowing, right?
All the locals, Anuj, I mean, for that matter, locals have not sold, right? Locals have been buying. I think Naren made that point. The domestic, I mean, actually, his point was that look for, there is downside in sectors where locals have been aggressive buyers because there has been no selling. That is the big risk which many fund managers have pointed out as well. I just want to sort of, to take off that point of ONGC. This is a completely contrarian way to look at it. What the government has done today, in a way, does this reduce policy uncertainty? I mean, the natural inclination would be to imagine that this increases policy uncertainty, right? But look at it this way. ONGC was pricing in $40–45 of oil realizations, right? Brent oil realizations, where Brent oil was actually $100 plus. So ONGC was expecting this in a way. What quantum, what degree, we don't know. That's why there was such a large difference between the implied value of ONGC and where it actually was. Now that they have said, government has said that we will take away $40 out of the $110, which means that ONGC actually will make $70 realization.
But then the issue is, then it becomes an FD, right? I mean, that there's going to be a certain, the issue is, when oil prices are down, in that case, ONGC doesn't get compensated. But when oil prices go up, that basically goes, as I said, absolutely nothing wrong against what the government might be doing. But my issues are completely different. that stocks like ONGC, or for that matter any sector, any stock which has any kind of policy risk associated with it, will never get its full value.
Oh, yeah, I mean,
that's exactly the point, Anuj. Even today when I was talking to a lot of investors, portfolio managers, the feedback was, if this happens to ONGC, can it happen to power, can it happen to chemicals, can it happen to any sector, right, where there is an inflation concern and the prices are going up. You can have a government intervention and that can have a
I think the bigger kind of thing was that with ONGC, the price was telling you that something will come at some point.
Yes.
But it was not expected with Reliance, I think, right?
Yeah.
Because this is, I think, the first, maybe in this way, this is the first time that private companies are being asked to, share the burden as well. Usually the subsidy used to be shared between the government, you and me, the consumer, between upstream companies and downstream companies. Now the private sector is involved as well. But we'll kind of sort of pick on this point with our guests on the other side. I just want to sort of quickly highlight the global setup as well, although that took a backseat on Friday, that is today. So this is a broad way of looking at things. Growth is slowing down, and I think the data points will come up on your screen. Over the last fortnight, 2 weeks, data after data, high frequency data after data in the US is showing that growth is coming off meaningfully. But there is no indication as of yet that policymakers, which is central bank, that is the Fed, is taking notice. Actually, the two quotes, which is one from a regional Fed president and the other from Powell himself, who spoke at the ECB conference on Thursday, indicates that they are very comfortable with what the market is assuming, which is the fact that rates actually have a lot more higher to go. So it's very clear that they are going to increase rates even though growth is going to slow down meaningfully. So I think that's important. The other thing to watch is, I think, commodity prices. If you remember, till last week, we had that big cut in commodity prices. Oil fell $14. Commodities this week, nothing, right? I mean, commodities have not continued their fall. So what happens there? Because that feeds directly into inflation. And I think if you go back in history and look at past cycles, yields have never peaked when we're at the early stage of a sort of rate hiking cycle. Where we are, we've only got 150 and 175, and perhaps there is more to go. So, a couple of things on the global front to watch out for. But
I love the way you said, this happened on Friday, as if it was a long time ago. It was such a long day. It's been
I'm not
such a long
joking, Sonia.
day.
8 hours ago seems like an eternity ago.
It does.
It's just,
I agree. But you know what? I mean, just to put everything together, right? What happened this week is that on the Nifty, a lot of key levels were broken, right? Eventually, the bears were on top. The Nifty slipped below the 20 DMA. The big question, at least that I have on my mind, is that will the Nifty hit a 52-week low? The next level to watch is the 52-week low of 15,183. With the way things are going, as you said, growth is slowing, etc. But lots of things to watch out for. So just a couple of cues on my radar. Auto companies, so there's at least some relief on that front. There was a month-on-month improvement that we saw in sales this time. The big takeaway really is commercial vehicle sales have picked up, and that's a barometer of infrastructure activity. There's been a pickup over there. Ashok Leyland more than doubled its sales on a year-on-year basis. Apart from that, guys, you can't, hang up your socks anytime soon, because it's earnings season coming up full-blown starting next fortnight. So here's the list, right? I mean, just look at the calendar. TCS on the 8th, Wipro on the 20th, HCL Tech on the 21st, Infi on 24 July. It's interesting. After a very long time, Infi is coming out towards the end of the month.
And it's a Sunday. It's a Sunday. It's actually leading to a lot of people thinking, what really is happening? Because, look, I mean, IT sector is going through a bit of a tough time. And I think if the fear of US recession is there, the first sector to get impacted really is
an hour before we kind of were preparing for this, the news came that Facebook, Meta, has said that they are expecting, quote unquote, this is a news report, a fierce economic environment. I mean, this is attributable to a senior Meta official, and they've cut their hiring targets by 30%.
Yes.
I mean, it kind of talks to what's happening in the tech space.
And in the US, right? I mean, Tesla, Meta, everyone sort of cutting back on their workforce. Just a couple of more things. Monsoon progress is also very key to track. It's the second month of the monsoons, and in June we saw a deficiency of 8% that was recorded. The rupee has been hitting record lows, so the RBI intervention, etc. We'll be tracking all of that. But let's do one thing. Let's take a quick commercial break. Don't go anywhere. When we come back, lots more coming up on the Editor's Roundtable.